Welcome to Just Think About It with Nadine and Ben. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, YouTube, or your platform of choice. Second, we appreciate any kind notes as we get started and letting your friends know where to find us. Today, we're so excited to delve into the financial underpinnings of our economy and markets with Charlie Peabody. If you care about the U.S. economy, the banking sector, public markets, your portfolio, anything, I could go on and on. Well, you've come to the right place because Charlie is a founding partner of Portales Partners and one of our partners over at Wall Street Beats. He's been analyzing U.S. banks since 1981, and his coverage list over the past 3 decades has included the money center banks, brokerage firms, regional banks, and trust banks. And what sets Charlie apart is his ability to take the macro views and translate them into micro impacts on a bank's P&L while keeping an eye on the big picture for your positions and portfolios. He's been quoted in major news publications, including Bloomberg News, the Financial Times, the Wall Street Journal, New York Times, Reuters, and others. And he's a frequent contributor to financial media, including Wall Street Beats. Prior to founding his firm, Charlie was a financial sector research analyst with S&P, Merrill Lynch, Kidder Peabody, Drexel Burnham, and UBS. Welcome, Charlie. It's always so fun. We get to see you all the time, but this is special because now we get like extended Charlie here on the podcast.
Well, I'm honored to be on with you two.
Hey, Charlie. It's great to see you. Thanks for coming on. So we're filming on August 5th, and our partner and friend Charlie came on the show not too long ago and kind of agreed with kind of our view, but he publicly came out and said we're going to get a sharp dip in the market. So given that the NASDAQ was almost down 10% in the last couple of days, tell us what you're thinking about that, Charlie, and what made you think that the market might take a dip?
Well, let me first, put out there what I said. So this was late July, and I thought that we would have a short in terms of time and sharp in terms of magnitude correction in August. So a double-digit decline in August. And at the time, my thinking was that fundamentally the narrative had gotten ahead of the fundamentals, and certainly that played out recently in the AI sector. But my area of specialty is the financial sector, and I thought that had been the case in the financial sector when the regional banks took off in July. And then, I was aware of some, offsides in positioning, some lack of risk management in terms of not protecting against the downside. And so I thought, if things started rolling and we broke 5,500, it would really accelerate. So there is a combination of fundamental factors and technical factors in my thinking. I will say, I think this is not complete yet. I don't rule out, a midweek type of contra rally, maybe Wednesday, Thursday, Friday, a two or 3 day rally. But I don't think the correction is over with. And I think we will be down at least 10%, maybe 12% before this thing finds a bottom.
And so before we ask more questions fundamentally, when you make that kind of call, right, that really short term, that you're going to see 10+% drop, you're talking about the end of this week, what are the types of things? I mean, Ben and I talk about this all the time, that you're not just spewing. It's like a lot of these calls are based on, your whole history of understanding the plumbing of financial systems, how people trade, so understanding the markets. So when you make that call, maybe tell people who are listening, what are the key things that you're thinking about? You mentioned something about people being offsides, way too far along on their skis on the AI side. But how do you make that call?
Well, all of those things were out there, in June, July. I mean, and Ben has been putting, on Wall Street Beats, posting, brilliant observations about these things.
Brilliant?
Yes, brilliant.
Thank you, Charlie.
So, what I had kept saying to some of the people I was talking to is that we've entered the art part of the market, and things don't matter until they matter. I mean, we were pointing out that Silicon Valley, a year before it went bust, was in trouble. And the fundamental issues we pointed out existed for a year before they mattered. And so that's kind of where we are right now in the art part of the market, not the science part of the market. And you just have to feel your way around. So I don't want to go through the litany of things that Ben has posted, but they were all there.
And maybe before we go into some more detailed questions, just so people have a perspective on your background, as your career as a bank analyst over 40+ year bull market in bonds and stocks, could you talk a little bit about, where you came from and what influences how you think about markets and positions today?
Yeah, so I have no formal training in economics. I was pre-med and went to medical school. And so I left medical school before I graduated and tried to get a job on Wall Street. And I have rejection notices that I could wallpaper my house with. So I wasn't very successful. And this was 1980, trying to get a job in the middle of a recession. Anyway, I did, go through the training program at Standard & Poor's, which is, pretty meek. So I was recruited out of there fairly quickly by Merrill Lynch because I was, quote unquote, a rising young star. And that's where I taught myself banking with the help of the Southern bankers. And I want to mention these Southern bankers because it leads into something that Ben and I have been talking about. These Southern bankers all were around in the mid 70s, that 73, 75 period. And most of them almost failed. I don't know if you remember Citizens Southern of Georgia or Barnett Banks or Southeast Banking Corp or NCNB. But they almost failed in 73, 75 because of the REIT debacle. And it's a period that I think there are analogies to today. But anyway, they taught me banking. And so, I've learned on the go. And that's why I say I think I have a sense of markets, having been around for a long time, but no formal grounding in economics.
And so, when you think about a 40-year career over what I like to term the rise of the Kerry regime, or you might call it the Great Bond Bubble, you've seen a lot of banking cycles. This SNL one in the 80s, one that's probably not talked about as much these days, obviously 2008, all the way up to the SVB. I mean, what do you see today that's similar to then, or are we out of the woods relative to where we were a year ago?
Well, I think there are a lot of similarities, and you've pointed out a lot of them. But back in the early 80s, for example, Bank of America had a huge S&L in the middle of its balance sheet, and it was underwater in a lot of their positions, and it almost failed at that point in time. So you go back, 6-9 months, and Bank of America again was in the spotlight for the underwater portfolio and the unrealized losses in their bond portfolio. We had failures, throughout the 80s. I cut my teeth following the Texas banks. And so I started following them in 1981. And by 83, 84, they were in trouble and showing signs of wear and tear. But it wasn't until 87, 88, these Texas banks failed. And it just shows you how long a real estate cycle is before all the hidden problems are revealed and start to take their toll on the survivability of some of these banks. So my feeling is, while we're not looking at a 2007, 2008 in terms of the banking system, that you will see a commercial real estate play out in a negative way for some of these small community and regional banks. And I do think over the course of 25, 26, we're going to have hundreds of regional bank failures, but it's going to be the small guys, not the large banks.
So when we think about SVB, then that was much more of just mismanaging the duration risk, in essence, after that huge amount of time where we had such low rates and the only way to make any yield was the long end.
They failed the old-fashioned way by taking interest rate risk, and we've seen that in many different cycles.
And would you say, what's the greater risk to the banking system? Is it the interest rate risk and the long end getting away from them, or is it some kind of credit cycle that we go through?
Well, I think it's going to be a combination of those two things. And the credit cycle, I think, is still ahead of us. And that's why I've been very cautious on, joining this rally in the regional banks. The interest rate cycle right now seems to be benign. but I'm of the opinion that we're going to see higher rates in 25, 26. And so if I'm right about that, and if I'm right about, and we can come back to this, about the housing market being in trouble, I think those things are going to weigh on the credit cycle, along with commercial real estate and unsecured credit in the card space. So I think there's a big credit cycle ahead of us that's going to cause the current optimism around bank earnings to flip-flop in 25.
And can you maybe tell folks, why do you think rates are going to go up? Because I think a lot of people are hearing Fed's going to cut, central banks are cutting outside of maybe Japan, but why will rates go up?
Well, I think it's going to be sort of a reflexivity action on the part of the Fed. I think the Fed is going to, if we're right about what's going to happen near term, the Fed's going to respond with some very aggressive rate cuts. And typically, and very possibly, I think by the end of this month or in September, they'll end QT. And by the end of the year, they may start QE again. And people will, translate all of that flip-flopping from tightening to injecting liquidity as likely to reinflate things. So I think that's at the base of my beliefs, is that rates could go higher. But short term, believe it or not, I'm still long the TLT here and haven't sold out of any of my position there.
And when you think about the Fed cutting here, where do you think they'll cut to? Because I think that when we look in, there's a lot of cuts priced in, 200 to 250 now. Last night it was even more extreme. We gave a little bit back. And that's where I think the dynamics of how this comes. Do they do 200, 300, and then the long end basically doesn't have much juice left? Because, go ahead.
Yeah. I think the number of cuts is again going to be a function of how the markets react. If we get easing financial conditions, because short term the bond market continues to stay low, below 4%, and the equity markets finally do come back in October, November, December, I think the Fed will say, I've done what I needed to ease financial conditions. But ultimately, I do think we're going to have a credit cycle, and Ben has talked about this, that spread widening trade in credit, in corporate credit, is going to come back with a vengeance. And I think we're getting those warning shots. Ben, you know better than I do where the junk bond spreads are right now, but I think they widened out quite rapidly in the last 2 or 3 days.
Yeah, we saw, Nadine and I have been working on that for the last couple months, and corporate credit was so tight. And it was basically at the tight since the GFC, and you've seen about 10 to 15 basis points in the IG, and then the high yield was about 45, 50, and it happens fast. Just it's just like volatility.
Yeah.
But
and then sorry, go ahead.
Go ahead. No, you go ahead.
No, I was just going to point out, credit card losses are still running 3-4% in the major banks that deal with the higher quality borrower. And those can go to 6, 7, or 8% in a recession. So I don't think we've seen the worst of a credit cycle as it relates to a recession.
And do you have a view? Some of the credit guys I talked to have said one of the reasons why IG and HYG and high yield have stayed tight is because a lot of guys moved into the CLO space, and there was less covenants and it was a little bit more borrower friendly. Do you have any view on that?
Yeah, I mean, that's been. Let me back up a second. To some extent, I think the large banks, the banking system that is controlled by the large banks, is going to prove very good in this next downturn at having managed their balance sheets prudently. And I think as they come out of that next credit cycle, they'll get re-rated upwards. So longer term, I'm very constructive on the biggest banks, but I think we have to go through that credit cycle where they prove that they've managed their balance sheets prudently before we get that re-rating. And I say that because I think it was Wells Fargo that came out about 2 or 3 weeks ago and said that banks are going to be re-rated higher. And I don't think that's the case short term, but I think it is the case longer term.
So everything's a short?
Is everything a short? Not everything, no. But I guess where I was going with that, and now I just lost my train of thought. Nadine.
Sorry.
um, was that a lot of the problems in cycles are created right at the end of the cycle. And what you look for are those institutions that are taking market share at the end of the cycle, because that's where the problems are created at the end of the cycle. And in this cycle, a lot of the market share gains were taken during COVID or during that ZIRP interest rate environment. And the biggest sector that I've seen in terms of shift out of the banking system for credit creation has been to the private credit, private equity system, or to these monoline credit card auto finance companies. And they, bought assets at the peak of the market, or originate assets at the peak of the market with 0% financing. So I think that those institutions are the ones that are going to suffer the most in the next downturn. Now, where that's a risk to the banks is a lot of these banks are financing these entities. They're providing subscription lines to private credit or warehouse lines to a mortgage finance company or dealer financing, et cetera. So there's a counterparty risk that I think you're going to see repeated again and again and again, such as what you saw with Archegos. And it's that counterparty risk is where I think you're going to see the banking system have some losses that right now people aren't focused on.
And Charlie, this just reminds me, I remember back in the GFC that, a lot of private equity shops, including where I was at, give loans out based on your portfolio to the people working in those firms. So they kind of get a double whammy when the value of the underlying portfolios, in this supposed 10-year locked up fund, which they've been extending and extending, much to the dismay of LPs, goes down, and then their personal wealth, they start get margin loans just like portfolio managers do, based on the loans that they took out for their second or third homes or their planes or whatever. So you could see a really interesting credit cycle from those folks, right? Because there's just so much money got sloshed into VC and PE, but on the upper consumer end side.
Yeah, absolutely. I mean, there's leverage upon leverage, and that daisy chain, when it does unwind, just has a phenomenal ripple effect. So yeah, I think we have to get a little further into the credit cycle, and that's why I'm not calling for this correction to be the big one. But I do
it's just
believe
10 to 12.
10 to 12, yeah. I mean, listen, individual companies are down 20 to 40, so 10 to 12 sort of understates the amount of damage that's being done to portfolios right now. But what I do believe, and Ben's much more eloquent in discussing this than I am, is that we are going to have a recession next year, and in that kind of environment, corporate margins can drop by 30%. That's not unheard of in a recession. And so if corporate margins today in the second quarter are running around 11.7%. And a 9% margin is kind of where I think we're going in corporate America. If earnings today are for the S&P 500 are 240 plus or minus, people are thinking 270 next year. I'm thinking 220 next year.
Oh,
you put a 16 multiple on a 220, type of, you're talking 3,500, 3,600. That's a kind of a 30% drop from the highs this year. And so I'm not sitting here saying we're going to have a deep financial crisis like we had in the great financial crisis of 08, or that we're going to have a severe recession. In fact, the recession itself could be quite mild. What I think is we're going to have a very significant financial correction, and in terms of corporate earnings. And that's why I'm much more bearish about a bigger pullback sometime in 25.
It's interesting you say that, because one of the things that we always show, there's this chart that we have, my firm, showing what's pumping up markets or causing markets, and is it multiple expansion, is it earnings, is it dividends, share, those kinds of things. And it's really been just this massive multiple expansion. So unless you can't keep the party going unless eventually you get earnings to increase, which I think is why a lot of these analysts have forecasted, right? Earnings going up because they're in the market to tell you that there's a party and you should play, you should come to the party. But if you don't get those earnings, you're saying there's a huge delta where it's expected versus what you expect, then that ultimately hits your multiples. And so going, like, if we kind of start with this earnings season, there's NIM, loan growth, multiples, maybe play out what's been driving the strength of financials, and then how do those elements or the key elements you think play out in the next year or so? What are you going to be looking at to say, okay, it's happening sooner or later, or to what degree?
Yeah, and those are excellent questions, and remind me. I'm going to want to come back to that, answer that question, but you'll have to remind me because I'll probably forget. Because what I do want to point out is in that thesis of a 30-50% correction next year, I do have rates going higher, and that higher rate environment is also why multiples would contract.
Yeah.
And to build off of that, who knows why Buffett is selling Apple or why Buffett is selling Bank of America, his two largest positions. And I have some theories, some of which are benign and some of which, are a little more dramatic, if you will. And I've written about this, but what do Apple and Bank of America share in common? And Nadine, you keep me honest here, but I know Bank of America, if rates go higher, they have this huge unrealized loss, 100 billion plus loss in their balance sheet, which will impair their capital from outside perspective. Apple, I think these tech companies are viewed as long duration assets.
Correct.
And so if rates go higher, then their multiples will contract as well. And I think that's what Buffett is saying in the sale of these two very different assets, is what they have in common is they both will be hurt by higher rates. So I just wanted to get that out since now what was your question?
Yeah.
It was something about the earnings of the banks.
So what, you got NIM, loan growth, multiples. You talked a little bit about multiples here, but when you roll out the time frame, 12, 18 months or however long, what are you looking for? How do you figure out then, the time is near versus it's going to take a while longer, the magnitude of call it the decline in margins, which then may lead to multiple depression or whatever you want to call it, a contraction at least. So what are the things you're looking for in the financial realm or outside of that to give you that cue, like to better sense of when and how much?
Well, the one metric that I think is the most important in bank stocks and how they trade is what we call PPNR, pre-tax, pre-provision net revenues, which basically is revenues minus expenses. So it takes out the credit component. And on that front, what we started to hear this year was net interest income, which is part of total revenues, NII, top line revenue, spread income, they're all the same thing. Net interest income, or NII, was going to start accelerating in the back half of the year. And then when July came around, the banks that were sort of the poster child for that started backtracking a little bit, and I'm talking about a little bit, about the ramp up of that NII progression. And that to me was a red flag. So they were promoting that NII was going to start growing, but they were backtracking on how much it was going to grow. And so it suggested to me, and I'm talking about, I can go into more detail if you want, but Bank of America, PNC, Wells Fargo, JP Morgan, all sort of started to backtrack on some of their year-end forecasts, but the progression of higher was still maintained, and that's what they emphasized. But
so what are they looking at to give that call, to change the call? What are they seeing, each of these banks inside or under the hood to make that type of call?
Well, there are a couple of expectations. So the first is that we'll see better loan growth. That's very important to their NIM and NII growth, and we haven't seen that yet through early August. Particularly on the corporate side, we haven't seen it. The type of loan growth we're seeing right now is in the credit card space, and I suspect that that's negative selection or distressed borrowing. You borrow on your credit card because you have to. But we haven't seen, and we're certainly not seeing demand in the commercial real estate space, and we haven't seen the typical type of CapEx borrowing or inventory finance borrowing. on the corporate C&I side. So loan growth is not picking up the way they had hoped for, at least so far. The other is they expected that the rotation or the migration from non-interest-bearing sources of funds into interest-bearing would slow, and that has happened. And so, the banks have been very rational in their pricing of interest-bearing deposits. So while that migration from non-interest to interest-bearing deposits has hurt their margins, they haven't had to pay up for funds yet. And I think we're going to start to see that they're going to have to start getting more aggressive in what they're paying for their interest-bearing funds. Right now, no bank is paying over 3% for their interest-bearing funds. And this is in a Fed funds world of 5.25%, 5.5%. So they're being very skimpy in what they're paying, you and I. So I don't think we've seen the worst of the beta related to their cost of funds, particularly if I'm right that liquidity starts to contract and gets squeezed here. And then the final thing is, what's going to happen to deposit growth? And they're assuming that they have low single-digit deposit growth in the second half of the year. And I just wrote about this in a piece this weekend. If we don't stop QT right away, I think we're going to have another liquidity squeeze, and money is right now being drained out of the excess reserves of the banking system, and that has a very good correlation with what happens with deposits. So if excess reserves continue to shrink, and we're at about 3.1, 3.2 trillion in excess reserves in the banking system right now, if at the current pace of what it's been declining, we could be somewhere around under 3 trillion in a month's time, and maybe towards 2 to 2.5 trillion towards year end. And in a reserve-based monetary system, if excess reserves get down to 2.5 trillion, that's a very tight, system. The Fed wants to keep excess reserves somewhere around 7 or 8% of GDP. So what GDP is 30 trillion, 7 or 8% would say you're tight down at 2 trillion. I saw it, Nadine. I rambled there.
No, we're listening to the storyline, and so if you have, I assume the Fed is seeing this, right? Knows it, or like put your mind inside. What is the Fed thinking right now?
Well, there's a Machiavellian part of me that says,
I love this. Is this conspiracy theory, or what is this?
Kind of. There's a political angle to what's going on right now, and I'm as apolitical as they come. I really am, and I'm not sure I understand how politicians think. Yeah. But there is a cry from one side of the aisle not to cut rates because it's political.
Look unfair, right?
Yeah, it's unfair. And there is a cry from the other side, led by Senator Warren, to we're moving into a recession. You got to cut now, and you got to cut fast. So I think the Treasury and the Fed have been working hand in glove, to try and control this rate environment. And I think they would like for a public outcry to occur where the public demands a rate cut from them, and that gives them
cover. Gives them cover to do it. Okay.
Yeah. And so if we are working towards some sort of liquidity event, such as we had in September of 19, when the reverse repo rate went up, it spiked higher, and the Fed immediately turned to QE, that could work to the advantage of what Treasury and Fed want to do. And, I'm jumping around here, and so Ben, keep me, on track here. But I wrote a piece earlier this year about the fact that the Treasury issued SDRs, special drawing rights, to the Fed. I think it was early July that they did that. And that's disclosed on the Fed's balance sheet in a weekly release called the H41. The issuance of SDR certificates from the Treasury to the Fed is not something that happens every year or every quarter or every month. It happens once in a decade. Last time it happened was, in 2009 during the financial crisis. So what happens is the Treasury issues these SDR certificates to the Fed. The Fed, in turn, issues dollars to the Treasury. Those dollars are deposited in the Exchange Stabilization Fund. And those exchange stabilization fund can be leveraged dramatically, and to provide liquidity to some place that needs that support. And I'm wondering how that money, I have not heard yet how that money is going to be used, or if it has been used. So I'm curious.
And if you put your conspiracy hat on, like, where is it most likely to be used?
Well, if we are moving through the draining of the reverse repo facility from money market funds, and we're draining the banking system of excess reserves, and that's going to, demand a rate cut because the markets, become dicey, then that's where they could employ that. Or if they were, working with the Bank of Japan, with the yen and the dollar, it could be deployed there. I mean, there are a number of different places that it could potentially be deployed. Or I guess I think we need to do more digging as to why these SDRs were issued to the Fed. And my gut is by September, we're going to see a full-scale investigation into what's going on with this.
Who's going to do that? Like, how do people listening figure that out?
Well, I think it's the kind of thing that comes up in, policy reviews. Let's call it that.
So Charlie, when you first joined Wall Street Beats, we did a special macro show with Annie Constant and Craig Shapiro, and you had made a statement, and that was around the time I was starting to change my mind, because I started this year shorting rates, and I thought that the market was ahead of itself. And then it was right around that time I started changing my mind. And then we kind of were in the same line that maybe these guys, the Treasury and the Fed, were starting to do this active Treasury issuance / pseudo yield curve control. And you had argued that. Why do you think it is that they are so much more focused on the long end, and they didn't really do active QT, but they kind of smoked the small business owner and the lower end by having the rates as the tightening mechanism, which we didn't even really get that tight? Do you have any thoughts on that?
Yeah, I mean, I think they did smoke the long end. I mean, if you think about it, Powell announced that he was going to start tapering QT, which takes some pressure off the long end. The Treasury said it was going to continue with its heavy T-bill issuance. And, they were going to go over their normal 15 to 20% limit of T-bills as a percentage of total marketable securities. I think you saw that the coupon issuance picked up somewhat, but not as much as people had anticipated. Then the Treasury did announce a buyback program of off-the-run coupons, which is a form of yield curve control. And then they are working on, products, from what I understand, that would be related to inflation and take some pressure off the long end as well. So I do think they suppressed the long end. Yeah, and I think, that's part of my thesis for next year is these unnatural acts have a price to be paid down the line. And it's very hard to time when that is, but I think it's going to be 25 as to when some of these suppressions of the yield curve will start to unwind.
And our friend David Dredge, who's on a past episode, has talked about the long end is where the risk lies, the uncapitalized risk. And, I guess you're right. They did smoke the long end. And then we get to the fall of 22, March of 23 with SVB, and then the fall of 23 again. And each one of those times, when the long end gets close to 5, it's all these maneuvers and the pivot. And, they've done a great job, actually, of making people believe the recession was right around the corner for a long time, right?
Yeah, no, they really have. And they still have some things in their pocket. You and I have talked about how at some point they'll probably remove the restrictions on the SLR, the supplementary leverage ratio, for banks to buy Treasury securities. Right now, a bank, if they buy a Treasury security, they have to hold capital against that. But they could take that capital requirement down to zero and make it more enticing for banks to hold Treasuries from a total return point of view.
So that's interesting because we can talk about two things in terms of regulation. That's one thing. So we have the election coming up. What does that mean for both sides of the regulatory? And then maybe talk to the state of Basel III Endgame as well.
Yeah. So, the election coming up, that was part of the July trade that I thought had gotten ahead of itself. It was, if Trump is elected, we're going to roll back regulation, particularly at the CFPB. That organization would be obliterated. And so you saw the credit card stocks trade off of that in part, as well as the seasonal improvement in delinquencies. And that really took credit card stocks up big time. And I thought we'd gotten ahead of that fundamental reality on those two trades. The other is that you would start to see the antitrust effort under the Biden administration be rolled back. And so you'd see a lot more M&A activity. So the feeling was we're going to have this boom in investment banking. And investment banking has a multiplier effect in capital markets revenues because, as you do more M&A, you're doing equity, retiring equity issuances, you're doing IPOs, et cetera. So that whole enthusiasm, took the capital market stocks like Goldman Sachs up. But in this unwinding, I've published two pieces on, how Goldman is financing, this boom. And, they have a line item called FIC financing and equity financing. And that has been growing dramatically as a percentage of their total revenues. And so they are financing this financial asset bubble. And if we have any kind of degrossing or significant pullback in the holdings of hedge funds and private equity, Goldman's earnings are going to show up as being much more cyclical than what they're trying to present themselves as. Because you remember, Goldman 5 years ago started this transformation where they were going to add consumer banking to their platform. And the argument was consumer banking was going to be much more annuity-like in their revenue stream and therefore would take the cyclicality out of the trading and investment banking part. And that strategic effort blew up on them. So now they're claiming that the financing of the public markets and of the private equity markets is generating a net interest income stream that is much more annuity-like. And I think we're going to find out that it's just as cyclical.
So Marcus, that was called. I was trying to remember the name of that business, the Marcus business that they bought for billions and then went poof, right? So you're saying there's like the new Marcus.
It was the Apple credit card, the GM credit card. And they pretty much unwound everything, on the consumer finance side of Marcus. They still have to sell off, the GM card and the Apple card.
So I want to follow up on the private credit, private equity, VC part, right? So if these losses are in the system, we're just kind of waiting to account for them. Where does the pain come, or where is the collateral damage? Is it pensions? How much does the bank take? Or is it just the LPs and the pension gets the pensions? How does that play? How does that dynamic play out with the shadow bank versus, the one we know in 2008 where it's, the real bank that has all the impairment risk?
I have a conceptual sense of how that's going to play out. I'm not sure I am qualified at the micro level to tell you how it's going to play out. But, a lot of these private equity guys, as I said, bought assets during ZIRP at the low end of the pricing cycle. I'm just looking for some notes because, I had some thoughts about that. Anyway, the bottom line is they bought assets at peak prices, and their accounting practices. So during this period, they also bought insurance companies, and my understanding, this is where I want to be careful, but my understanding is insurance companies have accounting practices that are a little more liberal than what banks have to do in terms of marking to market. And there's a little more flexibility because insurance companies deal in long duration assets in terms of marking those things. And this is what I learned during the Texas banking debacle and how long it takes for a long duration asset to come clean in terms of its real true value. So these private equity, private credit guys bought insurance companies. So Apollo just recently talked about Athene being a drag on their second quarter earnings. And it was the derivatives portfolio that created some losses in Athene. But this is my suspicion that they use these insurance companies to put some of these impaired assets in their holdings, insurance company holdings, and therefore don't have to mark to market. They can mark to myth or mark to model. And it takes a while for that process to be realized. And one of the things that could force that realization is if you have these required increases in casualty reserve liabilities, such as you saw a couple of weeks ago with Selective Insurance Group, SIGI. And so they have to start liquidating assets to meet those reserve needs. But and when you do that, then you're forced to recognize the true value of those assets. So it's more of a sense of how things are done, having lived through the great financial crisis and saw how banks hid the problems in the mortgage space. But at the same time, I know they're dealing with other people's money, so they don't have any skin in the game. And there's massive insider selling going on by these private equity, private credit guys. And there's no oversight or regulation the way there is in banking. So it's a very opaque business right now, which actually brings up one other point, and then I'll shut up. The regulators have been trying to get private credit and private equity to become more transparent. And they've tried through a series of what we call sunshine acts to expose or give transparency to what they're doing. And these funds, including the hedge funds, have been very successful in pushing back in the courts and have won many of their cases so that they don't have to expose what they're doing. And so then the regulators went to the banks and said, well, instead of holding 200% of capital against the subscription lines you have to these guys, you're going to have to hold 400%. And the bank said, fine, we'll do that, and we'll just pass along the cost. And so it's been very difficult for the regulators to rein in these private equity, private credit, hedge funds. And, in some trades, like the basis point trade, they're levered 100 to 1. I don't know if you know about the basis point trade, but it's basically we're buying, cash market and then selling the futures against that. So to me, that's shades of long-term capital, which was doing off the run versus on the run. And the regulators are very concerned about that. And I think they want to find a way to rein in these private credit, private equity guys and hedge funds. And so one possible way is to designate them as G-SIFI. A G-SIFI would be a systemically important financial institution. If they were to be designated as G-SIFIs, they would fall under the auspices of the Fed, and the Fed could start imposing liquidity and capital constraints. Now, something like that is not going to happen under the Trump administration, given who's funding him. But if Kamala Harris is elected, we could see next year an effort by Yellen to designate some of these. And by the way, just so you know, the framework for this was put in place last December. They created a framework. They created a process for notifying these institutions, a process for it to be debated and negotiated. So all of that infrastructure to do this is in place. There just hasn't been any movement yet.
Interesting, Charlie. I was just thinking about how many calls I get from places, UBS, Goldman, Morgan Stanley, trying to sell these private funds, right? Because now they're selling them to retail. They're really kind of expanding to get more capital in. So you have this really perverse situation as well that's probably magnified beyond what people understand versus prior periods where a pension might hold that fund and, some very, very wealthy individuals, but it's come down to a lower end consumer, if you want to call it, right? So maybe not a qualified purchaser, but accredited investor being pumped these private funds because they generate a lot of fees shared with the private equity funds or VC funds. So you have probably a lot more consumers or individuals and entities that previously had held this stuff, but I'm not going to pick on which consulting firm, but pick your consulting firm that private equity, returns some of the best returns because they don't have to mark to market, right? And they had, free debt for a long time, but they don't really think about that, and they pay the fees to these wealth managers or these groups, and then they get in these like locked up assets they don't really understand.
Nadine, you hit the nail on the head. I wrote about that last November when this framework was being developed.
So you're telling me I'm old news?
No. It's kind of interesting because there's an old adage that if something you write doesn't have immediate impact in the market, it gets forgotten by Wall Street. And I kind of feel that way about my yield curve control piece because I wrote that in May, and then Nouriel Roubini brought it up a week or so ago, and Yellen had to come out and deny that they were practicing. This SDR report that I wrote in July I think is going to get some visibility, but the July report got no visibility. So it's as I said, when I talked about Silicon Valley, it doesn't matter until it matters.
Right.
That's the art part of the market we're in. But I think you're absolutely right. By bringing in the consumer, it's given a whole new doorway opened up for the regulators to say, okay, now we've got you and reason to regulate you.
You talked about yield curve control. Obviously, last night, big moves over in Japan, right? And in the last couple of weeks, because of raising rates and concern about the economy here in the U.S. Maybe you can talk a little bit about, we know what's happened till now, but what is the Bank of Japan thinking, or the things that they could do that could affect the U.S.? So you've kind of talked a little, you're hinted at least maybe working in concert, but obviously they wouldn't have wanted this big of a move this fast to crater their markets overnight. And so going forward, are these actors going to have a different playbook, or what do you expect out of both of these actors?
Yeah, we're getting a little out of my area of expertise, but I do have some thoughts which I'll share, and you can.
That's why, I want to know your speculation.
But I think the Bank of Japan has to be very careful because you've got, as Ben knows, a bank over there called Norinchukin that has huge unrealized losses in their bond portfolio. So they've got to be careful about pace and which they raise rates. So I think Japan's problem is going to be helped by what the U.S. Treasury and Fed do. And that's part of why I think they're going to be cutting rates here and weakening the dollar. I mean, Ben, when we did that call back in the spring, when that yield curve control piece came out, I think Herb asked me, what would you buy as a result of this information? And I said, well, it depends on the asset class you're trading. But we talked about, and you, I think, did as well, about buying the yen and buying the Mexican peso were the two currencies we mentioned at that time. And I think that's been a decent trade so far.
Well, it was the best carry trade there was. It dominated the NASDAQ. And then in the last little bit, Nadine's actually been a proponent of the yen on the show and to me. And we had a big carry unwind. So the peso yen went from 930 to, I think it hit the lows last night, like 720 or something. It's been a dramatic move in the yen. And, going long the yen has been called the widowmaker for a reason. There's been a lot. I've personally done it and not too much luck. I started trying to do that 2 years ago. And I think that's part of the reason why we've gotten the absolute viciousness of the move that we had in the market is like the perfect combination of the IWM, which people short to buy stuff, and then shorting the yen and to buy dollar or peso. And it just tons of leverage from banks. Probably that group at Goldman you talk about is one of the ones that fund it. And then all at one time, just boom. And so, carry unwinds can be violent.
Yeah, and I don't think it's over with, but maybe to bring this full circle from where we started in terms of what's happening now in the markets. As I said, I don't think it's over with yet. But, it'd be interesting to see if we could, given my thesis that it all happens in August, there's a bookend at the end of August that could conclude this. And that is on August 28th, you have NVIDIA reporting earnings, and August 29th, you have Powell, speaking in Jackson Hole. And so maybe there's a, double whammy where NVIDIA comes out with great earnings and restores faith in the AI theme, and Powell makes it very clear that he's cutting rates in September, and we get a restoration of, easy monetary policy. And maybe that concludes the sell-off. Thinking out loud here.
And that actually, we've talked about a little bit, but that matches what happened in 07. You had the market peak on July 12th, July 11th, kind of like now. And then we had the two Bear Stearns funds go out. You had Solwood Capital go out. And then we had all of the AQR and those guys have which wasn't even credit, right? That was just equity. And so it feels a little bit like this, right? You're calling for 10 or 15% decline, and that's kind of what we got then. Then we get the rally into the end. Do you feel as though it's kind of a playing that playbook, or just it's just coincidental?
I mean, as you've said, Ben, I mean, things, don't necessarily rhyme, but they do, they don't repeat exactly, but they rhyme. And I think there are a lot of elements of both the 73, 74, 75 period, or what led into that, recession and market correction, to what's going on today. And I think there are elements of 2007, 2008 that are, repeating again today. New Century Financial was the first bank failure in April of 2007. And then it was a year later that we had the real financial crisis. Well, Silicon Valley was the first big bank failure, and now we're starting to see the warning signs in this kind of correction. 28. When did we have? I'm going to call on your memory, Nadine. When did we have the Spanish flu? Was it 1928?
Oh boy, you're asking. I am such a bad. I'm not like a history buff. So hold on, here we go.
1919, 1921.
21.
There you go.
And so it was 8 years before the crash of 29. So COVID was 2021. If we're going to have a significant bear market in 25, 26, you can draw all sorts of analogies, is what I'm getting at.
So for people who are listening, and we won't keep you that much longer because I know everybody's had a long day today and last night. So how do you trade this? Because you've been calling short Goldman, you're obviously short KRE or other regional banks, and then you're saying, okay, we can see this hit here in the near term, call it this week or this month, but then you can have this, these couple of positive catalysts coming. And then, I don't know how long before the next shoe drops, and you're calling for the next, year or so, having other issues like more of the credit cycle hitting. So are you trading the market? Are you making, more intermediate long-term calls? Give a perspective for those listening, what you do, so that they also understand when you're answering these questions, right? How does an expert like you think about your own portfolio?
Well, first of all, I'm an analyst, not a portfolio manager, but I do. I
know, but you have your own portfolio. I know it.
I do manage.
I know it.
So, but the bottom line is that, yeah, I do set up for tactical events like this correction in August, and started doing that in the second half of July, when the premiums on puts were very, very low. And you could see that no one was buying protection because it hadn't paid for so long. So at this point, you can't do that. I mean, you got a VIX at 50 or 60,
Sure.
You can't do that anymore. So what I'm doing is harvesting, my investment money or seed money, and letting the house money ride, because I don't think this, correction is over with. But I did also start to nibble today in some trades that I think will play out positively between September and January of next year. With the analogy, of 72, 73, that maybe we have a rally into January of next year. So I've been buying some crude oil. I'm buying the futures, not the stocks at this point. I didn't get executed, but I had a bid in there on Citigroup this morning. I think Wells Fargo, a couple points down lower, it would be attractive. So I'm trying to pick up things that I think could benefit from a year-end, October, November type of rally.
All right. Well, I know we could spend a lot of time with you, Charlie, but you are tired. I know it. But thank you for wearing that hot shirt to keep us awake on a day like this.
I've been up. I was up at 1 to 1:30. I was up between 3 and 4, and then I got up permanently at 5:30. And my brain is mush right now.
So how do people find you? You're talking about when you're communicating to folks and writing your newsletters. If someone wants to follow you and or subscribe to you, what do they do?
Well, first of all, if you look at my hair, you know that I don't understand social media. So, so I'm not on social media.
You're not on TikTok and Instagram?
No,
I think you'd be good.
As long as you wear that shirt.
Yeah. Maybe a dance.
Portalis Partners LLC does have a website. We deal strictly with institutional investors, so I apologize, no retail. I can be contacted at cwp@portalispartnersllc.com by email. And we have a main number, which probably I won't, someone won't pick up, but you can leave a message at 860-245-5737.
A phone that no one will pick up. That sounds like a great lead.
Your P.O. box.
Actually, where individual, non-institutional people can go? Wall Street Beats. They can hear your viewpoints on a daily basis when you show up there. So I guess I'll plug that one in there because I don't want to exclude somebody if they think they can't find you.
Yeah, we have a client base that we enjoy, and I think we like it like that.
But it's fun having you on the Wall Street Beats. We enjoyed your audition in the spring.
Well, thank you. I hope next time you'll catch me on a day where I'm not brain mushed.
Thank you so much.
Yeah, thank you.
Thanks, Charlie.